Parag Parikh Flexi Cap fund.
Yes.
And if you have been looking at this scheme for enough number of years, like you and me, Prableen, then you will have heard comments by people when it was even at 20,000 crore assets under management. And when people were saying, oh, you know, it's gotten a little too big, it's not going to be able to deliver the same kind of returns. But they've proved everybody wrong multiple times. Let's talk about when it was launched and what the initial journey was and the fund managers.
Right. So Parag Parikh, it's a flexi cap fund. That means that it has the flexibility to move across market caps. It can invest in a large cap, stock, mid cap, small cap without any sort of a binding. It was launched in the year 2013. And Mr. Rajiv Thakkar has been managing the fund since inception. The benchmark for this fund is the Nifty 500 Total Return Index, Alex. And I think the fund philosophy, as the tagline on the website of Parag Parikh, it reads that we value investing. So definitely it's a value-oriented fund. They have time and again proven that the factors that they give importance to are just not merely buying stocks, but they're looking at businesses which have low debt ratios. They are clean and transparent managements. And that is what I think they have tried to do even at their own scheme level. High level of transparency, and it's a 10 on 10 for the fund house on that front. They've stayed away from any kind of fancy themes, businesses or sectors. So a very conventional approach, but amazingly managed with a huge investment of their own in the fund, Alex. That's an interesting thing. The managers themselves have close to 500 crores invested in the scheme, and they've been really active with the cash calls they've taken. They have exposure to international investing, something which wasn't a trend early on. And the fund house has been actually one of the pioneers in that. Now, because of the restrictions, the allocations abroad, Alex, have come down to about 12.5%. But what's interesting in terms of the fund positioning, that if we look at 2019, so just going back 5 years, the top three stocks at that time were Alphabet, HDFC Bank and Bajaj Holdings. And HDFC Bank and Bajaj Holdings is still the two top stocks which they are having. And of course, Alphabet is still there. The percentage has gone down because of the restrictions. So overall, very well managed, very transparent fund house, and the returns have been great as well.
Yeah, industry beating returns and certainly benchmark beating returns. Of course, when they have taken those large cash calls, they've done so at the cost of those returns. But then it's been proven over the long term that they've been justified in taking those calls. One aspect that I very quickly want to address, and we should run through some of this very quickly because we have limited time, is that as the assets under management goes up, probably the expense ratio goes down, and you've alluded to this as well in the data you've sent me.
Yes, yes. So another point, Alex, here, because you mentioned that they've taken cash calls, and that has actually helped the fund to sort of lower the downside, and that's very nicely captured by the down capture ratio of the fund, which is at 45 for a 10-year period and 53 for a 5-year period. So that's excellent, and that is what has helped the fund to definitely lower the risk as well overall. And great returns. They've beaten the benchmark on XIRR and rolling return basis. And there, of course, the expense ratio as the size, it was just about 2,400 crores back in November 2009. And look at the size today, it is almost close to 85,000 crores. And the expense ratio has gone down from 2.11 to 1.33, Alex, for the regular plans, and it has come down from 1.18 to 0.63 for the direct plans. So obviously a reduction in the expense ratios, and wonderfully managed with a lot of focus on the downside risk protection.
Which is why a lot of people own it. Let's very